Hello, still we are going to talk about incremental analysis. This one is going to be on repair, return or replace equipment. It's a decision that companies often encountered, and they have to take decision whether to repair the equipment or to return it or to replace it. So this one we are going to look at this question, and before you watch the video, pause the video and read the question so that we don't waste time in reading the question. So this is what we have. To make the question very clear, it's a hospital that has to make a decision whether to replace, whether to retain its old scanner or to replace it with a new one. So let's say this is the old scanner and this is the new scanner. So for the old scanner, we have the following information. The price of the old scanner was $100,000, and the operating cost is $105 per annual. That is every year. The useful life of the scanner is going to be 4 years. That is from the beginning, from the day of purchase to the end is going to be 4 years. The purchase period, it was purchased on January 2nd, 2013. And price in January 2nd, 2014 is going to be $40,000, which is exactly after a year after the scanner has been purchased. In the new scanner, the information for the new scanner is this one. These are the important information that you need to consider for new scanner. The price of the new scanner is going to be $110,000, and the operating cost is going to be $105,000. minus $30,000. If you look at the question says that it will save the hospital $30,000 this in operating expenses if the hospital agree to replace the scanner, to buy the new one. So the operating cost is going to be $75,000 per annual instead of $105 for the old scanner. So the useful life for the new scanner is going to be 3 years, and the purchase period is going to be 2nd January 2014. That is a year after the old scanner has been purchased. So if you look at the useful lives, because now we are in 2014, January 2nd, so the useful life is going to be 17, because that one, for the old one, the first year has already passed. So now they have it has 3 years left, and this one, the new one, is going to be 3 years useful life. So these are the information that you need to look at. Then the requirements of the questions, if you look at it, the first requirement is says, if Benson Hospital sells its old scanner on January 2nd, 2014, that is a year after it has purchased it, compute the gain or loss on the sale. So this is the first requirement. So how do you compute it? And if you look at this table, we have, okay, for the first requirement, this is what we have. We have cost. What is the cost of the printer? That was the not printer, the scanner, the first scanner. It was $100,000. Then the accumulated depreciation was $25,000, which is after 1 year, the depreciation is going to be $25,000. Then we're going to get the book value. The book value is the value after the accumulated depreciation has been subtracted. So the book value here is $75,000. Then the sales proceeds. If the hospital agrees to sell the scanner, the proceed that it will get, that is the money that it will get from that sale, is going to be $40,000. So if you look at it here, we actually have a loss on sale. We are going to lose, the company is going to, the hospital is going to lose $35,000. So it's a loss on sale. This is the requirement A. Okay, the second requirement says, using incremental analysis, determine if Benson Hospital should purchase the new scanner on January 2nd, 2014. So how do we do it? This is how to do it, to do the incremental analysis for it. Okay, So we have, these are the information that we have here. We have return scanner, that is if the hospital is going to return the scanner, it's going to keep the old scanner and use it. And here we have replace scanner, if the hospital agrees to replace the scanner. So eventually we're going to have net income increase or net income decrease. So what do we have here? We have annual operating cost. This is the first thing that we consider, the annual operating costs. How much is the annual operating costs of if the hospital return the scanner? The annual operating costs, if the hospital agrees to, if the hospital doesn't want to replace the scanner, is going to cost the hospital $315,000. That is for the remaining 3 years that it has. And if you look at it, this is how we get it here. 3 years times 105,000, then it's going to give you this amount. This is the annual operating cost that it will cost the hospital if they retain their scanner, their old scanner. Then if they replace the scanner with a new one, then the annual operating cost is going to be $225,000, which is, if you multiply this amount, 75,000, if you remember, by 3 years, is going to give you 225,000. So this is going to be the annual operating cost for the new scanner. That is if the hospital agrees to replace their scanner with the new one. Then that will amount to net income increase of $90,000. Then the next thing to consider is the new scanner cost. How much does the new scanner cost? So for the return scanner, we don't have anything. For to replace the scanner is going to cost the hospital $110,000. Okay, then that will be a decrease in the net income. So the net income will decrease by $110,000. Then the next thing to consider is all scanner salvage. That is the all scanners like resale price. If the old scanner is being resold, so what is going to be the salvage value? The salvage value here, we're not going to talk about the return scanner here, because if the hospital return the scanner, so there's no money. So here, to replace the old scanner, to replace the scanner with the new one, the hospital is going to get actually 40,000 from the new scanner. So it's going to be minus for the new scanner. So that is why we have it in brackets, and that is going to be an increase in the net income, which is $40,000. So now if we look at the total now to return the scanner, the total amount that it will cost the hospital is going to be $315,000. And if the hospital is to replace the scanner with a new one, it will going to cost the hospital $295,000. So if you take this one and minus this one from it, it's going to give you $20,000 net income increase. So if you look at this, the hospital is going to be saved. If the hospital replaces the scanner, then the hospital will get it will save itself from $20,000 this amount. So this is the decision here. The decision should be yes, Benson Hospital should replace the old scanner because it will result in savings of $20,000 over the next 4 years. So the hospital will get a saving of $20,000 if the hospital agrees to replace the old scanner with the new scanner. So this is it for this one. And the last question, the last question is explain why Benson Hospital might be reluctant to purchase the new scanner regardless of the result indicated by integrator analysis. So in such situations, sometimes because of so many reasons, certain reason, the hospital might be reluctant. They might not want to replace the scanner, because if you remember in the A above, we get a loss on sale. We get a loss on sale of $35,000. So because the hospital might not want to record some loss, they might not want to record a loss in their this income statement, so they might be reluctant to replace the scanner, even though it's going to be a saving for them. But because of that, if they don't like think critically, they might not agree to replace the scanner because of that the first decision above. Thank you.